Meaning and scope of managerial economics. Welcome everyone to this particular sweet short videos on managerial economics, the meaning thereof and the scope we will try to identify. Economics is usually defined as a social science concerned with analyzing and describing production, distribution, and consumption of wealth. Stephen Robbins' definition is more recently an economics called Lionel Robbins, as the case might be, defining economics as the science describes that behaviors of human being as a relationship between given as in ends and the scarce mean or the alternative usage of it. That is what Lionel Robbins would be doing around it. Again, I repeat, the science which describes human behavior as a relationship between ends and scarce mean what have an alternative or which have an alternative usage. Managerial economics is essentially applied to economics in the field of business management. It is economics of business. It is economics of managerial decisions between the ends and the alternative usage. Please understand that is what we want to go around it. The means and the ends and the alternative uses. It pertains to all economic aspects of managerial decision making. It is an evolutionary science. It is a journey with continuing understanding and application of economics, knowledge, theories, models, concepts, categories in dealing with emerging scenarios of businesses, emerging managerial situations and problems in the dynamic economy, should I say that, the dynamic market per se. So there are types of business decision. How many? Six. One is price and output decision. Second is demand forecasting. Third is the choice of technique of production. Fourth is the advertising decision. Fifth is the long run production decision. And the sixth is the investment decision. Now, what we are talking about is we are talking about choice of a technique of production and long run production decision. What is the long run? Should we do it all by ourselves? What is the choice of technique? Should we do all by ourselves or part by ourselves, part by vendor, and part by someone else? Now, how do we look into it? Now, these are the types of business decision that a manager needs to entail. The nature of managerial decision making problems requires choices among alternatives, courses of action, so as to achieve the objective. Let us understand with the help of an example. Consider a, a company, Suzuki Limited, which manufactures cars. Suppose it identifies two possible course of action called strategies to meet the growing demand of the product. First strategy is to plan its internal expansion, the Suzuki of production capacity. The second strategy is to take over the Premier Auto Limited. Some companies or anything, let's say Hyundai or in this case a Toyota or anything that we're talking about, a Premier Auto Limited, and uses its capacity, its factory, its production line to increase the output to make the growing demand of its product. Objective of the firm is to maximize profit, to earn from the expansion of the output. So let us understand S1 stands for strategy one, increase its own production ability. Or let's say take up a premier automobile limited or any other production basis which is already running for some other brand, maybe Kia, maybe Toyota, maybe Nissan, you name it, and we have it. Suzuki decides to take up their facility and start producing its own lines of productions. Now, what am I trying to tell it to you? This is what the strategy 2 is all about it. The objective function of the above decision making can be stated as to maximize profit, S1 and S2, two strategies. To choose the two alternative strategies, the following decision has to be made. Choose strategy number one, in-house production, increase the in-house capacity. If profits from dollar one from S1, sorry, the strategy one, are more than the profit from strategy two. Choose strategy two if the profit from strategy two is more than that from the strategy one, perhaps. So, managerial decision making, what we are looking at, 5 steps in decision making process. Establish the objective. This is what we are looking into it. Define your problem and start identifying alternative solutions, alternative course of action. Consider legal, social constraint, evaluating alternative course of action and choosing the best, considering financial, technological, infrastructure and input constraint, implement and monitor the decision thereby. Managerial economics, what are we looking into it? It is an integration of economics, decision science, and business management, amalgamation of all the three traditional economics tools of techniques of decision sciences, along with managerial economics and the dynamic business environment, the business management theory, practices, decision problem is all what entails as managerial economics per se. Managerial economics bridges the gap between the traditional economy, the real business practices for the purpose of facilitating the decision. This is the real economic theory. This is the business scenario, the business management, and what in between is the economic decision, the managerial economic decision that has been put forward by the top management. Characteristics. Let me give you the microeconomics. Managerial economics is nothing but microeconomics in character, mostly in microeconomics in character, as it is concerned with smaller units of economy. It supplies the problem, principles, it studies thoroughly the problem, the principles of an individual business firm and or all individual industry. It assists the management in forecasting the individual trends in the market as the case might be. Second is the normative economics. From microeconomics to normative economics, managerial economics belongs to the normative economics. It is concerned with what management should do under a particular, or should I say, a peculiar circumstances. It determines the goals of the enterprise and develops the best way to achieve the goals. It deals with the future planning, future policy making decisions, making full utilization of the available resources of the enterprises. Third approach would be the pragmatic approach. Managerial economics is pragmatic. It tries to solve the managerial problem on a day-to-day basis, on a day-to-day functioning, on a day-to-day operation, and avoids difficulty issues of economics theories. Using of the theory of firm, the fourth option, managerial economics uses economic concepts, economic principle, which are known as the theory of firm or the economics of the firm. Thus, its scope is narrower than pure economic theory per se. The fifth one is to take the help from the macroeconomics. Remember, it is taking help from macroeconomics. It is essentially a microeconomics problem, essentially a small segment that needs to be identified, decision has to be taken forward through. Managerial economics takes the help of a macroeconomics into because it needs to understand the circumstances, it needs to understand the environment of the individual firm or the industry has to work. Issues of macroeconomics whose knowledge is necessary for the successful management of the firms and the industry. Business cycle, taxation, policies, industrial policies, price, distribution policies, wage policies, anti-monopoly policies, as the case might be, and that is what we want to go around it. What are we looking at? We are looking to aims at helping the management in arriving to a decision which is akin to their objective, end objective perhaps. Managerial economics aims at helping the management in taking the correct decision, preparing plan and policies for future perhaps. The scope of managerial economics include the following subject, the sixth subject: theory of demand, theory of production, theory of exchange or price theory, the theory of profit, the theory of capital investment, and the environmental issues. Again, I repeat, the theory of demand, theory of production, theory of exchange or price theory, theory of profit, theory of capital investment, and the environmental issues thereby. Allow me to expand the scope of the managerial economy. It is the theory of demand that we want to work around it. Spencer and Silgam said a business firm is an economic organization which transforms productivity sources into goods that are to be sold in the market. Demand analysis helps the management in identifying the factors that influences the demand for the product of a firm. For an example, an estimation of future sales is essential before preparing production schedule and employing productive resources. Thus, demand analysis and forecasting is essential for business planning. Thereby, we are talking about demand theory is a study of behavior of consumer. It answers questions such as why do consumer buy a particular commodity, such as how much should they purchase a commodity, what is the income of an income habit, effect of income habit and taste on demand of commodity, what are the factors influencing the demand of the commodity, when and why do consumers stop consuming a particular commodity altogether. Then comes the theory of productions and cost analysis is what we are trying to do. It is very very important for smooth functioning of the production process. Production theory helps in determining the size of the firm, the level of the production. It explains how average marginal cost changes can impact the production. Under what condition do cost increase? Under what condition do cost decrease also? How does total production increase when the input of one factor of production remain in keeps on increasing, or other factors being kept on constant perhaps? So how does it impact the production thereby? Scope of managerial economics: how can one factor of production substitute another when all factors are increased simultaneously? So how can optimum production be obtained? That is what we all try to achieve, not to compromise on the quality, not to compromise on the cost. Theory of exchange, the price theory, if I may say so, it explains how prices are determined under different market conditions. How and to what extent advertisement can be helpful in increasing the sales of the firm. Definitely, at least the public gets sensitized about the availability of a particular service, particular product. Pricing is thus very important area of managerial economy. Pricing policies affects the demand of a product. It also includes the pricing method, the pricing policies, differential pricing, product line pricing, and price forecasting thereby. We are talking of the theories of profit. Profit maximization is the aim of each and every firm that is right now existing in each and every corner across the world. Profit is the difference between the total revenue and the total cost. Remember, total revenue and the total cost. Because of that following factor, the profits are always uncertain. Why? The demand of product. It might go up, it might go down. The prices of the factors of production, the nature and the degree of competition in the market, the price behavior under changing conditions. Hence, profit planning, profit management are necessary for improving profit earning efficiencies of the firm thereby. And that needs to be ascertained. The theory of capital investment, how do we go across with it? The theory explains the following issues: selection of the most suitable investment project, most one. Remember the Suzuki scenarios of whether to enhance their own production line, increase this, expand it, or probably acquire another Premier Auto Limited and utilize their capacity for the production of their own products. Selection of the most suitable investment project, most efficient allocation of capital, assessing the efficiencies of capital, minimizing the possibility, or let's say undercapitalization or over capitalization. We talk about the environment, the last issues with the environmental issues. Certain issues of macroeconomics also form a part of managerial economics. These relate to social, political environment in which the business industrial firms has to operate. This is governed by factors like the type of economic system in the country. Is it a mixed economy? Is it a capital economy? Is it a socialist economy? Is it a protective economy? Is it the segment of the economy which is being incentivized? So what are we looking at? The type of economic system of the country, business cycle, industrial policies of the country, trade, fiscal and taxation policy, price and labor policy, general trends in economy with regard to production, employment, income, prices, savings and investment. These all needs to be understood as far as the environmental issues are concerned. The general trends in the foreign country, foreign trade of the country, how developing is the banking sector, social structure and the political system need to be taken down, need to be understood, because it will give the stability to the economy or not. If the economy is unstable, does it make sense to be in a business, being present in that particular market? As the management of the firm cannot have control over other factors like these has been mentioned, it should adjust its plan. It should adjust its policies and programs of the firm according to the factor to offset any negative effect on the firm, any adverse effect on the firm. With this, I come to an end of this video. Thank you for watching it till the end.